The world is on a knife edge. While everyone's obsessed with trade wars and tweets, a far more dangerous game is being played, a golden showdown that could unravel the global financial system. Remember Trump's tariffs? That was just the opening act. China's response is escalating, fueled by record-breaking gold discoveries and a strategy that's been brewing for decades, waiting for the perfect moment to strike. And that moment might be now. Stick with me, because this isn't just about China. It's about the future of your money and America's place in the world. A dramatic shift is occurring in China's gold market. The World Gold Council reports that, despite record-high prices, overall global gold purchases reached record levels in the first half of the year. Major purchasers included the People's Bank of China, Turkey, and India. The notion that whoever holds the gold makes the rules has gained traction, particularly in China and Russia. Both nations view gold as a symbol of wealth and, crucially, a safe financial haven amidst economic and geopolitical instability. Consequently, since the 2008 financial crisis, both countries have aggressively increased their gold reserves. While currency wars are widely recognized, a less publicized gold war is unfolding between the East and West, particularly between China and the United States. Global instability, encompassing trade disputes, the conflict in Ukraine, and rising tensions over Taiwan, has heightened gold's appeal. The United States possesses the world's largest gold reserves, totaling 8,133 tons. China's official gold holdings have reached 2,280 tons, representing a record 5.5% of its total foreign exchange reserves. This places China sixth globally in gold reserves. Deteriorating relations between the two largest global economies have fostered a gold-centered rivalry. President Donald Trump's tariffs on Chinese goods initiated these tensions. China responded with a package of economic countermeasures against the United States. These actions signaled a clear escalation. Alongside these measures, Beijing updated its gold reserves, an act seemingly aimed at challenging the United States. Global markets are presently unsettled by the escalating trade tensions between the U.S. and China, prompting investors to seek refuge in safe haven assets. Historically, gold has served as a safeguard against economic volatility. Gold maintains its value because it is a finite resource with practical applications, and a form of wealth that can be exchanged no matter what the local economy is doing. The price of gold surged to a record high as new tariffs imposed by Washington and retaliatory actions from Beijing intensified concerns of a prolonged trade conflict. Trump's tariff announcements boosted spot gold, with a 0.8% increase to $2,818.90. Ongoing trade negotiations between the United States and China, along with broader macroeconomic data and geopolitical developments, are anticipated to significantly influence gold's pricing. Central banks' actions indicate Beijing's desire for increased gold reserves. China has resumed gold accumulation in preparation for potential economic uncertainty, particularly in anticipation of a potential second Trump presidential term, where a stronger U.S. dollar is projected. Goldman Sachs forecasts that gold could reach $3,000 per ounce by the second quarter of 2026, fueled by central bank demand. China's central bank augmented its reserves by 330,000 ounces of gold in the second month of expanding its holdings. As of December, China held 73.2 million ounces, an increase from 72.96 million in November. China's increased gold acquisitions follow a six-month pause, during which the world's second-largest economy reduced purchases due to record gold prices. Gold commenced 2025 with renewed vigor, building upon its strongest annual performance since 2010. It reached an all-time high of $2,849.5 per ounce, driven by trade tensions between the United States and China. As gold prices ascend, China's investment strategies have garnered scrutiny. The Chinese yuan has depreciated against the dollar over the past year, reaching a 16-month low. Ray Jia, head of China research at the World Gold Council, anticipates sustained investment demand for gold this year, driven by potential losses in the yuan and the prospect of lower interest rates. Increased futures trading also contributed to the significant performance of the Chinese gold price. The recent discovery of a significant gold deposit in the Huanggu region of China's Hunan province holds considerable importance for the global gold market. The discovery of the Huanggu gold deposit presents itself to the world. It is a colossal find, holding an estimated 1,100 metric tons of high-grade gold ore. The mother lode is valued at approximately $83 billion. The deposit's implications for the global economy, geopolitics, and resource management are a reality. The Huanggu deposit is a remarkable network of 40 distinct veins, running from the surface down to a staggering depth of 2,000 meters. Initial explorations yielded 330 metric tons of gold, with further deep exploration. Scientific modeling suggests an additional 770 metric tons could lie buried a full kilometer beneath the soil. The ore boasts a remarkably high concentration of gold, measuring 138 grams per ton, which makes it extraordinarily productive in comparison to global averages. This single discovery not only dwarfs the reserves of South Africa's South Deep mine, previously considered the second-largest deposit at 1,125 metric tons, but also shows China's advanced capabilities in geological exploration and mining technologies. China, being that it is the world's top producer and consumer of gold, can leverage the Huanggu deposit. In 2023 alone, China produced approximately 370 metric tons of gold, contributing to 10% of global production. However, the nation's consumption significantly outpaces its production. Historically, China has relied on imports from countries such as Australia and South Africa to meet this deficit. Furthermore, China's central bank has been aggressively accumulating gold reserves, purchasing 225 metric tons in 2023. The Huanggu discovery won't eliminate China's import needs, but it has significantly reduced the deficit and provided temporary relief to its demand for the precious metal. The discovery's impact extends beyond domestic consumption. The announcement itself triggered a surge in the price of gold, inducing volatility in mining and financial stocks worldwide. This significant discovery allows China to bolster its economic sovereignty, increase its foreign exchange reserves, and lessen its reliance on the United States dollar. These developments are in line with Beijing's ongoing strategy to reshape the global financial architecture and establish the yuan as a strong competitor to the dollar in international trade. The question arises, will this gold discovery become a major challenge to the United States? Certain analysts have long predicted the eventual demise of the United States dollar's special status as the world's international reserve currency. That may, in fact, be true. Historically, the dollar has maintained its preferred reserve currency status due to certain advantages. The United States possesses a robust institutional framework, characterized by established rules and constitutional checks and balances, providing a degree of stability for investors. Additionally, the sheer size of the U.S. economy and the depth of its financial markets offered a large pool of liquid assets, making the dollar an attractive store of value globally. Many countries even pegged their currencies to the dollar, directly or indirectly, effectively expanding the dollar zone beyond U.S. borders. Furthermore, a significant portion of global trade, including pricing of commodities like oil, metals, and grains, continues to be conducted in U.S. dollars. However, fissures are beginning to emerge. A growing trend among central banks is to reduce the proportion of their foreign exchange reserves held in U.S. assets. International Monetary Fund data indicates a decline from 71% in 1999 to 59% at the end of 2020, a 25-year low. Although this downward trend has been temporarily masked by the dollar's strength, it continues to have effects on other currencies. In conjunction with this shift, central banks have been increasing their gold holdings. The People's Bank of China is at the forefront of this activity, with official data indicating 17 consecutive months of net gold purchases as of March. The People's Bank of China's gold acquisition spree isn't malicious. The PBOC might have capitalized on an emerging market, being a shrewd investor. The PBOC may have embraced gold's traditional appeal, a safe haven, an inflation hedge, and a means of diversifying risk. It's also important to note that Chinese private citizens have embraced gold purchases, perhaps as a way to bypass the country's strict capital controls, particularly when domestic equity and real estate markets were struggling. As China's gold reserves swell, it could move closer towards establishing an alternative reserve system to the dollar. Does this undermine U.S. financial supremacy in the long term? Some experts assert that it's a deliberate plan of destruction, while others argue it's not so straightforward due to the world's continued dependence on the dollar. However, China is not acting alone. Recent official data reveals that Turkey actually surpassed China in gold purchases during the first 3 months of this year, with India also displaying a strong appetite for the metal. There's potentially a larger strategic dimension to China's diversification away from U.S. assets, particularly in light of escalating geopolitical tensions surrounding Taiwan and Beijing's increased assertiveness in the South China Sea. The shift towards gold could enable China to create a war chest, shielding it from potential U.S. sanctions. Russia has already adopted this approach, and other nations could follow suit. China's gold accumulation might also serve as a subtle warning of its potential to leverage its substantial holdings of U.S. government bonds as a weapon. The mere threat of selling these bonds could elevate borrowing costs, not only within the United States but across the Western world. Furthermore, the United States could become its worst enemy. The recent strength of the U.S. economy and markets is, to some degree, a consequence of massive fiscal stimulus, initially implemented under President Trump and sustained under President Biden. This is an action only a country issuing bonds in the world's dominant reserve currency can undertake. However, the patience of international investors and their traditional trust in U.S. institutions and policymaking is also waning. Both countries are facing the prospect of being drawn into a protectionist trade war, with tensions with China expected to intensify. This could manifest in various ways. It's plausible that the U.S. dollar's dominance will gradually diminish, potentially leading to a rebalancing towards other Western currencies, including the euro, the Australian dollar, and the Canadian dollar. Even the Japanese yen, appearing undervalued, sees bond yields rising to levels that could attract international buyers. Sterling, surprisingly, accounts for a larger share of global foreign exchange reserves. The pool of investable assets within China remains limited. The prospect of a coordinated response by U.S. allies to a new threat from China, akin to their reaction to Russia's invasion of Ukraine, also restricts the ability to evade sanctions through diversification away from the dollar. The gold market itself is not substantial enough to absorb all the capital China has invested abroad. Nevertheless, in a worst-case scenario, a precipitous decline in the dollar's value could trigger significant adverse effects elsewhere in the West, potentially manifesting in higher interest rates in the UK and the rest of Europe. The discovery of the Wangwu deposit also highlights the broader landscape of global gold reserves. Statista estimates Australia's current unmined reserves at 12,000 metric tons, followed by Russia with 11,100 metric tons, and South Africa in third place with 5,000 metric tons. Although the Wangwu deposit is crucial, it underscores the highly uneven global distribution of natural resources. This imbalance frequently fuels geopolitical rivalries as nations compete for control over these critical assets. Gold's importance transcends its monetary and geopolitical significance. For centuries, it has been a symbol of wealth, power, and cultural heritage. In China, gold holds deep cultural roots, playing a key role in traditions, weddings, and festivals like the Lunar New Year. Its universal appeal renders it indispensable in diverse industries, ranging from luxury goods to technology. As an exceptional conductor with high corrosion resistance, gold finds applications in electronics, medical devices, and even space exploration. As industrial innovation continues, the demand for this metal will grow. In an era defined by advanced mining technologies, the Wangwu deposit represents more than just an economic windfall for China. It symbolizes the nation's growing prominence in the global gold market and reflects broader trends reshaping the industry. As the world confronts the challenges of resource scarcity, environmental sustainability, and economic instability, discoveries like Wangwu serve as both opportunities and stark reminders of the finite nature of Earth's resources. For China, the challenge lies in wielding this newfound wealth responsibly, striking a balance between short-term economic gains and long-term environmental stewardship. The discovery of the Wangwu gold deposit is a landmark event with far-reaching implications, both domestically and internationally. Economically, it solidifies China's position in global gold production and consumption. Geopolitically, it provides a valuable asset for navigating a volatile international landscape. Environmentally, the deposit's exploitation presents challenges that demand careful management and innovative solutions. This isn't just about charts and numbers, it's about power and who wields it. China's strategy is bold, and the echoes of Trump's trade war are still reverberating. The question isn't if this will reshape the global financial landscape, but when and how drastically. Don't be a bystander. Educate yourself, protect your assets, and understand the seismic forces at play. This video is your starting point. Subscribe and join the conversation to stay ahead of this developing crisis,